This is the point of no return. While 98.7% of people scroll past this warning, you are the 1.8% who clicked to see the truth. Picture this. You are driving down a highway at 200 kilometers per hour. The wind is howling against the glass, the scenery is a blur of motion, and your heart is racing. Suddenly, you look down at the dashboard. The speedometer drops to 0. The car is still moving, the engine is still roaring, and the vibrations are rattling your bones. But according to the gauge, you are standing still. That is exactly what is happening to the silver price on this Tuesday morning, February 17th, 2026. Look at the chart in front of you, $75.56. It is a number that likely caused some of you to lose sleep last night. It is a number that looks like a crash, smells like a crash, and feels like a disaster. But let me be brutally honest with you. That price is a visual hallucination. It is like seeing a massive 90% off discount sign at a supermarket. But when you run inside with your cart, you realize the shelves are completely empty. You are being lied to by a line of code. You are being manipulated by a liquidity vacuum. And right now, we are going to perform a forensic autopsy on what just happened to your portfolio. We are going to separate the binary noise from the physical signal. Because if you don't understand the gist of this market update, you are going to be shadow banned from the greatest wealth transfer in human history. Welcome to the Silver Insider, the only channel that refuses to reward the paper myths. If you want the raw, unfiltered truth about the March delivery endgame, subscribe right now and hit the bell. We are dropping these truth bombs every single day while the market is this volatile. To understand why the speedometer says 0 while the engine is at redline, you have to understand the geopolitical niche bending of the silver meta. In a traditional market, there is always a referee, someone who makes sure the trades are fair. In the silver world, the only referee of the physical market is the Shanghai Gold Exchange. Usually, Shanghai acts as a floor. If the paper merchants in London or New York try to smash the price too low, the physical buyers in the East step in and say, "We'll take every ounce at that discount." This keeps the Western banks honest. But right now, the referee is officially AFK away from keyboard. It is the Lunar New Year. The Shanghai Gold Exchange is closed for the holidays. The arbitrage window, the conduit that moves metal from the cheap Western markets to the hungry Eastern markets, is nailed shut until February 23rd. When the adults leave the room, the children start breaking the furniture. The children I'm talking about are the Western trading algorithms. We are in a referee-free week. This is a power vacuum where the price on your screen has completely detached from the physical reality in the vaults. Stop multiplying your paper losses. Put down the calculator. The crash you saw to $75 was not a valuation adjustment. It was a liquidity cascade. These bullion bank algorithms are designed to sniff out weaknesses. They know that, without the Asian bid to support the floor, the price is vulnerable. They initiated a small sell order, a tiny push in a normal market. But in this holiday vacuum, that small push caused the price to slip. As it slipped, it hit the stop-loss orders of Gen Z consumers and retail traders. Your automatic sell orders triggered more selling, which triggered more algorithms, creating a recursive loop that has zero connection to the physical reality of supply and demand. Think about the absurdity. 10% of the value of a strategic global asset gone in 600 seconds. Do you honestly believe human beings around the world decided simultaneously that silver was worth 10% less in a 10-minute window? Of course not. That was a machine reading a line of code. That was a binary fingerprint of a high-frequency trading algorithm. Let's leave the flashing lights of the digital casino and go into the trenches. Close your eyes and come with me. It's Sunday afternoon. You walk into a small bullion shop in the middle of the city. The door chime has a personality. That little ding that sounds like it's been there since the 1980s. The dealer is standing behind the counter with a lukewarm coffee and eyes that have seen every crash since the 2008 collapse. The place is flooded, but not with people trying to sell. It is flooded with veterans and diamond hands who have held through every manipulation and every raid. They are not panicking. They are not selling. They are looking at the red candles on their phones, and they are laughing. Why are they laughing? Because while the screen says silver is dying, the shelves behind the counter are empty. American Silver Eagles? Gone. Maple leaf tubes? Only available if someone walks in to sell to the shop first. 1-ounce Eagles are trading at $9 to $11 over spot. Rounds are at $2 to $3.50 premiums. The dealer looks at a new customer, some kid who just discovered silver last month. Hans says it plain, the price on your screen is a lie. That is, the paper price. The real price, the SDR build price you pay to walk out with metal in your hand, is 30% higher, and it is going up every single day. This is the truth they hide from you. The paper price is a hallucination. The physical reality is empty shelves and premiums that make your eyes water. The dealer knows what's coming in March. He's seen this movie before. He knows that when the referee returns on February 23rd, the arbitrage window is going to slap these paper shorts in the face. Now, let's move from the smoke in the coin shops to the fire in the COMEX vaults. This is the smoking gun. There is a concept in criminal forensics called inconsistent behavior. If a store owner claims his business is failing and nobody wants his products, but every night you see armored trucks quietly driving away with all his inventory, you know he is lying. This is exactly the situation with silver right now. According to the chart showing silver at $75.56, the market is telling you that nobody wants this metal. Sentiment is terrible. The algorithms are screaming sell. But let's look at the COMEX registered inventory, the metal actually available for delivery. In just the last few trading sessions, while the price was being smashed down, the physical inventory in the registered category dropped from 98 million ounces to 92 million ounces. That is 6 million ounces of physical metal exiting the system in a matter of days. Think about the logic. In a normal market, when the price crashes, inventory should pile up. People should be selling, and the warehouses should be overflowing. But we are seeing the exact opposite. The price is crashing, and the stock is vanishing. This is what we call a divergence. It is a glitch in the matrix. It tells you that the people selling the paper contracts on the screen are not the same people taking the physical bars out of the vault. Registered silver has now fallen below 30 million ounces. This is the lowest level since the 2021 silver squeeze. In the last 48 hours alone, we saw another 2 million ounces drained. If you extrapolate this bleed, rate 6 million ounces a week against a remaining pile of 92 million. The COMEX is mathematically on a trajectory to hit zero in approximately 15 weeks, but it won't go to zero. The system will break before that. The premiums will skyrocket, and cash settlements will be forced on paper contract holders long before the last bar leaves the building. Why is March the final boss of the 2026 meta? Because we are staring at a mathematical cliff. Open interest is at multi-year highs, while registered metal is evaporating. Right now, we are looking at 380 million ounces of paper, demand crashing into a wall of only 105 million ounces of available supply. That is a 275 million ounce gap, even if only 15% to 20% of contract holders stand for physical delivery. Conservative estimate that is 57 to 76 million ounces they have to find. The COMEX has less than 30 million registered. Do the math, this is not theory, this is an inevitability. The shorts are trapped. They cannot cover their positions without forcing the price violently higher. This $75 price tag is not a warning. It is a clearance sale for the bullion banks. They are shaking the tree to see what falls out before the harvest season begins next week. They are scaring you out of your position at $75 so they can sell it back to you at $150.